Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Ebrahim. It's fantastic to have you on the podcast show.
Well, it's really a pleasure to be joining you. Thanks for having me.
Great. Now, before we go into the meat of our conversation, I do like to ask my guests something about their origin story. So could you tell me in your own words, what you studied at university, and was it inevitable you'd end up in finance?
Well, I did in fact study economics in college. So in some sense, it was at least an early sign of where I would end up. But what got me there was I was really curious about how the world works, how an economy works, and that meant that I was really interested in both the macro and the micro, not just supply and demand, but how people make decisions, how institutions work. And I carried on with that. I got a PhD in economics, but at the end of it, I was really interested in economic policy. I wanted to do some more applied work, and I got an opportunity to join Citi to work with the chief economist at the time, Willem Bouter, and I jumped at that. And it was really a fascinating period because it was after the global financial crisis, and this was a role that was really focused on economic policy, on crises. In my case, it was really the Eurozone crisis. That was the formative period, but also really plenty of projects. Whatever we thought it was interesting to get our teeth into, and it was really a privilege to work with Willem as well because he's such a creative thinker. But again, the universe was also had plenty of scope to get creative about all of these different topics. Again, crises, policy issues, and such like. So I did that for a couple of years on both sides of the Atlantic. But where my curiosity then took me was I was really passionate about how markets work. And I saw a bit of a gap in how we approach that in economics and even with a policy focus to how markets functioned. So I joined Citi's FX business as a macro and FX strategist, where I continued my macro analysis and try to understand macro dynamics and policy, but in the end, try to translate that into how investors should position in the macro asset classes and at the end, in particular currency.
Okay, great. Okay. Sounds great. Sounds like you've had some great experiences there. Now, we're recording this 1 week before the US elections, and also before payrolls, I should add as well, just for listeners to be aware while we have this conversation. So we can't really ignore the US elections. They're upon us. And so as someone who's been in markets for a while now, you have a markets hat, you have an economics hat. How do you approach the US elections?
Yes, so the day is finally almost upon us, and I think many of us can't wait for it to be there and over eventually. And there's plenty to say about the election, but let me maybe touch on 3 points. The first is I've long thought that this was probably the Republicans and Trump's election to lose, and this is really because of the context. And I refer to the Gallup survey, which is really illustrative and useful in that regard. And what that survey shows, it asks people for decades now, which party do you identify with? How do you feel about the economy and even the direction of the country as a whole? But also, what are the most important topics at this very moment? And if you look at this year's survey, then the results are really striking in the sense that they point both at a change in government, as in that the incumbents would lose, but they also skew very heavily in favor of the Republicans. And in the past, these responses have been highly predictive of the election outcome. So I think it encapsulates really well why, irrespective of the candidates and the specific policy platforms, this was really a very challenging election for the Democrats to
I mean, at the same time, when we look at polling and a lot of these, political pundits or pollsters, whether it was 538 or New York Upshot and so on, they tend to be saying it's neck and neck. It's a 50-50 race. But from what you've just said, you sound a lot more like confident in a Republican or Trump victory.
Yes, I say this humbly, but I do think the prediction markets skew more correct in my estimation. But even when you look at the polls, there are a certain number of polls where Trump does significantly better than in the average, and those tend to correlate a little bit better with the 2016 and 2020 outcomes. But even if you look at the swing state polls, and by now we all know that it's really the swing states in the US election that matter, what is very striking is that the relative performance of Trump is significantly better, significantly closer than it was in the last two elections. So even in terms of the polling below the surface, it does look like we should be at least attributing a higher likelihood to a Trump victory. At the end of the day, of course, we've had lots of surprises in elections, and this year was no exception in that regard. So a lot will come down to turnout on the day, which I think on the Democrats' case, the hope is really on women and on young voters. And in some cases, it can come down to the weather. So you certainly need to be nimble and flexible. But for me, the incoming information, including what we're seeing from early voting, so Republicans are doing significantly better at this point than they were in 2020 in terms of the available early voting information. It does look pretty good for them.
And in terms of how a Trump win would look in terms of the economy, in particular markets, what does it mean for markets, a Trump victory?
Yeah, so let me say two things about how I approach this election from an investing point of view. And the first is kind of more generally, this is a very visible election, highly researched. People are generally very well informed. So from an investor standpoint, it almost matters more, what the potential blind spots and surprises are than what the actual outcome is. So you're looking for the blind spots and what markets may be missing. Again, it's not that easy. It's not low-hanging fruit because there's so much effort so much effort goes into trying to understand this election. But otherwise, because it's such a visible event, I pay a lot of attention to the risk premium. So very visible means people will also try to hedge against such an outcome. And historically, that meant that you would get a significant risk premium, by which I mean equities would be sideways or down, and implied volatility would be pretty high. And yields would also be somewhat lower as people resort to safe assets. And as the event realizes, that uncertainty and volatility comes out, and both equities and yields tended to rise after the election. So historically, it was a really good idea on average to own, quote unquote, that risk premium. And I think that's still a generally good benchmark if the risk premium is high.
And this is irrespective of who wins. This is just an election premium,
I would say exactly. It's an average. So it's almost irrespective of who wins, but it is a risk premium because bad things happen. So on occasion, you will get an outcome that will be very negative for markets as a whole. But just in terms of the historical norms, it was much more common that resolution of uncertainty would be positive for risk assets in particular afterwards than that you get a negative outturn. And again, we've had a couple of events this year that suggested you do get negative surprises too, and they can be very painful for investors. So the risk premium can be there for a reason. Now, this year is quite unusual because I guess there are two ways you can put it. You could either say there isn't that much of a risk premium in equities. Equities certainly haven't fallen. I mean, the VIX is not low, but it's not particularly high, certainly not compared to the last election. Or you could say that the risk premium that's being built up is being built up much more in bonds than it is in equities. So I think that's very relevant for an investor. I mentioned to you, I broadly agree with the idea that markets should be pricing a higher likelihood of a Trump victory. So I don't disagree with the way markets have been evolving over time. And this is in the macro assets as well as the micro assets that are very sensitive to the election outcome. So there's no easy mispricing to see. But that particular aspect that you see a very high volatility and uncertainty price and the outturns kind of skewing towards higher yields versus maybe a little bit less of a risk priced into equity markets in the US, it does suggest some opportunities to actually seek exposure to perhaps the possibility of lower equity prices and perhaps not much more upside in yields around the election. So what I'm thinking of here would be something along the lines of buying puts in equities. They are quote unquote relatively cheap relative to the past elections. And now this might sound pretty brave in the current context. Selling puts in US rates, so being relatively more ready to accept exposure towards higher interest rates. And that's, of course, a positioning or an orientation that would probably do really well in a surprise Harris victory. So that's when this type of positioning would really pay off. But the reason why I think it's interesting too is because of the pricing, one that I mentioned. Rates volatility really high, equity volatility not so much. So you would take advantage of that to some degree. You could set this up in a pretty cost-effective way. But also there are scenarios in a Trump victory where you would still probably do pretty okay in this setup. And this is in particular because we've now reached levels of real yields near 2% in the US, where equity markets can start to be a little bit more vulnerable. And again, there isn't that much protection being bought into this election. So is there a scenario where maybe rates rise and equities sell off? Again, you're somewhat okay in this scenario, or simply that equities or that simply that rates can't rise all that much more. So if you structure and first of all optionalize it and do it in a way where coming from nearly 430 now in 10-year yields to 440 and slightly above, where I probably think the next holding point is for US rates. That looks like a good way to come into this election. Now you said already we have a lot of risk events coming into this big event too, not just payroll release, but also big earnings. So I think if you are seeking exposure to the immediate election.
Okay, so for in the run up, you think some kind of trade where one is exposed to higher US yields and then lower US equities kind of makes sense. Now in terms of the Trump scenario, I mean, with the Kamala scenario, most people have the view that at some level it's some kind of continuity with Biden policies. There might be some variation, but generally it's a continuity set of mix of policies. But with Trump, an interesting feature this time round is that last time in 2016 when he won, there was a clear, cutting corporate tax was the main plank through which markets viewed a Trump victory. This time you have some of that, but also you have the possibility of, a global set of tariffs on all countries. And he's also talked about expelling millions of undocumented workers. So that kind of introduces some more risk that could be a bit more negative for markets. I mean, how do you look at something like that?
Yes, so I think, first of all, we have to think in terms of the market implications of the election. There are really three time horizons that are relevant. There's that immediate surrounding of the election, where it's really positioning that makes a big difference in addition to the outcome. Then there's pretty much a year until maybe the end of 2025, which is when the tax cuts expire, the parts of the tax cuts which are set to expire, but also where generally, legislation works its way through Congress. And then it's that about a year after the election where often we've seen a kind of second wave of election impact. So you really have to, as an investor, be quite differentiated. And the reason why I highlight that is when it comes to that kind of a year or further into the future, a lot of the differences between the Trump and the Harris outcome, even abstracting from whether they will have unified government to begin with, which obviously has a huge impact, particularly on fiscal decisions, it's probably not all that large. And that is because, as you said, there probably is less room on the fiscal side to loosen further than in 2016. And on the other hand, I think there's a relatively low likelihood that even with divided Congress, the Kamala Harris government is going to try really, really hard to be fiscally conservative. So I think some of those policy differences are going to be something that markets will pay a lot of attention to down the road, and they may not quite line up with the original idea. What is also different, and you also alluded to too, is the setup going into the election. So we have much more highly valued equity prices, and the element of surprise for a Trump victory would not be there in the same way that it was in 2016. So from that perspective, there certainly is a lot less room for equity upside simply on the basis of a Trump victory. Now, this is not to suggest that you necessarily will see a sell-off post-Trump victory. I'm mindful that I suggested a positioning that points in that direction. Now I'm also highlighting that the outlook wouldn't necessarily be as much in favor as it was in 2016. I think there are other factors that still look pretty positive, and maybe we'll get to them for the broader risk asset outlook. But I think that simple calculus of Trump victory in 2024 would be a mirror image of what we saw in 2016. I don't think that applies.
Well, I mean, one of those big positives for equities is the US economy, possibly. It's been remarkably resilient. Many people have been calling for recessions constantly over the past few years, yet the US continues to motor ahead. I mean, what's your take on it? I mean, there are signs of the labor market weakening somewhat. Of course, we get payrolls, in a few days, but generally there's been some softening there. There's been some rise in credit card delinquencies and such things. So there are some cracks here and there. But where do you stand on the US?
Yeah, so my take would be to the optimistic side of the debate, and once again with humility. But that optimistic argument, I think at its core, is really about the strength and resilience of private sector balance sheets in the US, and that's both on the household side and on the corporate side. But on the household side, what is remarkable is the level of household net worth is very high and it keeps on growing. So we now have household net worth maybe around six times GDP, adding about a third of GDP every year. And the reason why I highlight that is not just because it's supporting US resilience, but it's also a big factor in why the US is doing so much better than a lot of the other developed markets are. So the strength of private sector balance sheets, and including households, immigration, and maybe some element of that AI investment are really the principal reasons why I think the US is outperforming the rest. So I think those arguments continue to hold. I hesitate to use the word structurally, but they are somewhat deeper. But in the short term, there are some supporting factors too. So you have post-election usually that some degree of pent-up demand and that uncertainty resolves. So you get an additional post-election boost. You get the benefit of the unfortunate damage from those big hurricanes. So some reconstruction efforts that in the short term should be positive as well. And those factors would get reinforced by a Trump victory, particularly if it was a sweep, but even in a divided Congress outcome. And these are some combination of deregulatory and sentiment effects. So for the time being, I do see a positive outlook, and certainly the avoidance of recession, some possibility of reflation in the US on a kind of 6-month horizon. But I say all this with the necessary degree of humility, because you mentioned not only have we seen some cracks, and there's clearly there are some areas of softness in addition to the labor market. I would highlight housing, and housing is maybe less important than it has historically been, which is why it's not the deal breaker argument as such, but certainly an area which continues to be weak, but also simply on the basis of a continued string of surprises. If we sat here 3 months ago, I would probably have sounded a little less optimistic about the outlook, and it's exactly because of some of the factors that were showing fairly consistent set of slowing and were partly revised away afterwards. So as Chairman Powell likes to say, you've got to be humble and nimble, but for the time being, I remain pretty optimistic on the US.
And what does this mean for inflation then? The Fed started to cut rates, so that implies they're comfortable that they're going to meet their inflation target. But do we still have to be worried about inflation?
Yes, so I, as a German and a monetary policy buff, inflation is very near and dear to my heart. And the way I think about it thematically is that I'm in the camp that 2% is the new floor, as opposed to the median or the likely average over time. Or you could say something along the lines of I think MMT has won, and the reasoning here really is that I think there's an almost infinite demand for public spending, and whether that is for let's call it conventional reasons, and this is health-related spending and pensions. It's for the climate transition, there's defense, but it is also because we've almost discovered a new technology where we have found a paradigm shift politically, where that demand for public spending is going to be met unless inflation really puts a constraint on it. So my thematic view is whenever inflation is soft and the economy looks soft, you're just going to have more room for fiscal loosening and public spending. And that therefore means that whenever you see inflation soften and the market pricing of inflation soften, there probably is a room to fade that. And that was the case in September last. And I think that was a great opportunity at the time. Now, it is still true that, I mean, my description here means inflation in the end is somewhat of a political or collective choice. So there's a bit of a difference between countries and how these things come about. It does depend on aspects of the political process. So, how the election turns out, and again, whether you have unified government will make some difference. But it does put me in the category of seeing at least more volatile inflation and somewhat of a higher range for inflation than we've had, and north of 2%. In the near term too, there are a couple of upside risks. So you get the drag from goods prices deflating, used car prices deflating. That's somewhat abating. There's a question mark about how quickly shelter prices will fall. So I'm not quite sure we'll see the same amount of residual negative seasonality in inflation in the US than we had in the last couple of years. And that therefore means that I do think central banks will continue to pay attention to inflation. This is not to say that at a kind of very short horizon, we're destined to see inflation pick up in a major fashion. But it does mean, I think, for the time being, I think we'll probably continue to look at inflation inflation at 2% from above, as opposed to.
I mean, so given your optimistic view on the U.S. economy, and then also this, more sort of dovish view on rates, you could say. I mean, inflation, I should say, that you expect inflation to be a bit higher than it has been historically. Does that then mean that your bias is for long-term interest rates yields to be higher?
Yes. So I am certainly partial to the view that both, the much maligned term of neutral interest rates being somewhat higher, but also that these combination of factors, so somewhat robust levels of inflation going forward, and the risk of structurally loose fiscal policy call for a higher term premium over time. So I am in the generally higher rates camp. Now, it does also apply in terms of the more near-term policy outlook, but I think that's more specific to the US. I think the US right now is unusual, where you have a resilient economy and maybe some sense of maybe stalling in terms of the downside in the near-term inflation trajectory. And that translates into the near-term drivers of rates, therefore, too. So if I think about the Fed, which I often do, I think there's a lot to be said about questioning whether the Fed really has much more room to ease beyond maybe another 25 basis point cut. So the Fed's projections are counting on a 4.4% unemployment rate by the end of the year. That's a couple tenths up from here. So it really does require further signs of loosening in the labor market, or some further signs of inflation weakening from now. So despite the fact that we've seen this pretty remarkable reversal in the trajectory of US policy rate pricing, I do think there's a very obvious question for markets, which is, are we going to be on this kind of consistent path towards, quote unquote, whatever the Fed currently thinks neutral is, or are we in that 1994-ish scenario or 2019 for that matter, where you get 75, maybe 100 basis points of cuts, and then the Fed gets to wait to see whether the economy.
It sounds like
really
your bias is more in that way. It's kind of a mini easing cycle rather than a full easing cycle.
Exactly. So right now, my model scenario would be that we might not see further easing, maybe even in December, and or maybe in Q1. Now, certainly this is an idea that's no longer shocking to the market. So it's not a home run from a risk-reward perspective in an environment where we're pricing certainly less than 3 cuts now between December and March now, so less than 25 basis points a meeting, but the risk reward isn't terrible either. So again, there is a scenario where you see no more cuts between December and March. So it's a roughly 1-to-1 reward, I would say. So nothing to sniff at. It is going to be sensitive to the election, so therefore it's not the ideal timing to get involved. And obviously we have that payroll print too. But it does, in my model scenario, point towards the possibility that this might be much more like 2019 or 1994 than we thought, just a month ago.
And you've mentioned central banks a few times now, and you've been a sort of central bank watcher for many, many years, and that's one of your areas of expertise. I mean, there is a viewpoint in markets that, to some extent, central banks are just reactive to the data. So just get the data right, and the central bank will just follow it. That for all the talk of central banks, being forward-looking and so on, they just react to events as they materialize. I mean, what do you say to that, and what is your way of looking at central banks?
Yeah, so I think there is a lot to be said that in the end, the data will determine the broad thrust of what central banks will do. And I compare that very much to how investors in equity markets would argue that earnings really tell you where stock prices will go. So I think certainly beyond a meeting or two, it really is the data that will pull the central banks along. But at the same time, I think central bank watching at its core is about decision-making in these institutions. So how these institutions work, how decision-making works. And that is particularly relevant for the very near term, and also for the differences between the central banks. So I think when you are a central bank watcher, it is, I would say, probably 1/3 investigative work around how these institutions function, how is that changing, how does it depend on the personalities involved, but also the political calculus within those countries. And then 2/3, and certainly over longer periods of time, what are the macroeconomic fundamentals of these economies? And of course, in particular about growth and inflation, but financial market factors matter to a differential degree, and certainly, in a time-varying fashion as well. But it's certainly been a passion of mine to kind of dig into some of these nuances. And I think, again, even if we just look at the most recent past, there's plenty of opportunity for investors to kind of tease out details and nuances that either suggest, some central bank is working slightly differently from another central bank, or the way that markets are interpreting certain data, or the way central banks are commenting on certain data may actually be somewhat misleading for the next central bank outcome. And that applies to the Fed.
I mean, given what you've just said, I mean, how would you compare or contrast the Fed and the ECB right now?
Yeah, so I think there are some very big differences between the Fed and the ECB. I would say structurally, and in terms of the current leadership, structurally, you do have that the Fed is historically a much more leader-driven organization, while the ECB is much more consensus-driven, and that's also, maybe a function of its relative youth, but of course also a function of the fragmentation across the Eurozone, not just in terms of economic fundamentals, but also how decisions are made in the European Union more broadly. But then in terms of the personalities, there's also a big difference, because you have what I would call the Powell Doctrine, which at its core really is about supporting the dynamism of the US economy. And I think it really came out of how they framed the September decision, where a lot of emphasis was about, we're dealing with a strong economy, but we are here to make sure that continues to be the case, while the ECB has historically, and to this day, has often had a much more narrow focus around its mandate, looking at inflation in a much more technical way and being much less concerned with the broader functioning of the economy. And in practice, that generally has meant that, of course, the Fed has been much more dovish than the ECB has been, much more proactive in many ways as well. But again, these characteristics, they're not independent of the data, but they color the responsiveness that you ascribe to the data points. And the art here is often to tease out where maybe the most recent information may be quite misleading in terms of suggesting what the future changes of direction could be. And I think what was really interesting to observe in that regard, and I think predictable, that there was room for a pretty big change by the ECB following a relatively hawkish September meeting. So I had been of the view that there was a big risk of a much more dovish outturn post that hawkish meeting. In the end, a lot of things fell into place to make that happen. But I think that's really what the art of central bank watching is about. To put
I mean, now that we've mentioned the ECB, there is this sort of pessimism that clouds everyone's views of the euro area at the moment, in terms of the state of the German economy, and the performance of the equity market and so on. I mean, what's your view on the European macro picture?
So I think my view is quite nuanced. So I do think there are plenty of reasons to be concerned about the European situation, and economically, as well as in terms of society and politics. And if you think about my own country, Germany is obviously at the very core of some of that sentiment and pessimism, and these issues are real and they're deep-seated and they're not easily addressed. That being said, let me try to be a little bit more optimistic or positive about it, or at least highlight maybe some of the slightly more positive aspects that can get lost in that sea of pessimism right now. And some of them are really situational. So we are seeing the ECB now being much more reactive to the weakening in the economy. We are seeing signs of credit demand in Europe picking up. We had a couple of slightly more benign data prints, and I would look at them very hesitantly and cautiously. And I'm speaking here of a slightly more positive IFO reading, but overall, I see much more downside in terms of the German near-term trajectory. But nevertheless, there are some, I hesitate to use the word green shoots, but there's some initial signs of at least a potential for an inflection point. But what's maybe more interesting and relevant for investors is there are pockets of opportunity even when you have this pessimism. And I do think European equities are actually somewhat attractive. And in particular, if you look at the European equities that are more exposed to the rest of the world, including, of course, the US, but now people are also looking at maybe upside potential back again in terms of Asia exposure too. So I think that could be a theme going into 2025. Investors will be looking at probably cheap areas of value and maybe potentially cheap sources of upside. And I think European equities will actually probably feature in that regard. So I think we've got to be cautious when it comes to Europe, and certainly.
I mean, you mentioned Germany's, your home country. I mean, there are big question marks about the structural state of Germany. In essence, the auto sector is not doing as well in a world of EV. The trade relations with China have shifted so that China's, got the upper hand in trade relations. So it's less China, exports benefiting from Chinese growth. I mean, do you have a view on just the structural trend of Germany?
So I think that the structural trends are very concerning, and along the lines of what you discussed. And I would throw into that large degree of public underinvestment over time, but more generally, really weak supply side policies. So you have a weakness of demand and supply, and that also tells you that in the end you probably need both of those to be addressed going forward. And again, I kind of want to bring it back to maybe a slightly more optimistic bent, which is, Germany, a little bit like Europe at large, has historically really only managed to change when it was under pressure. And we had the Hartz-IV reforms and the way that Germany came back in the 2000s. And we're seeing a few of those parallels in Europe more broadly. If you look outside of Germany, Ireland is doing well, Spain is doing well, Greece is kind of doing well, and Germany's not doing so well. So there are some parallels to the setup in the 2000s. Now, that didn't end up well, so hopefully we're not gonna end up in that same predicament. But what I'm really aiming at is we'll get an election. Some people are saying it could be as early as the spring. I doubt that'll be the case, but there's going to be an election which brings some prospect of, I think, both supply and demand policies in Germany. I struggle to project too much optimism, certainly in the near term. So again, for an investor, what has to come in then has to be price. And there again, it's just relevant that if you think about equities, for instance, the discount of German equities and European equities at large is pretty much at record levels relative to the US. And I think that will be interesting to investors, certainly in the value space. It will be interesting, I think, possibly even into the end of the year, particularly if we don't see a decisive Trump victory. So it could be a near-term opportunity.
Yeah, and then when you look at opportunities, trades, themes across markets, what are some of the things that stand out for you?
So I would maybe highlight three things. The first is, again, we're on the eve of a big election and a couple of these other risk events. So you clearly want to keep your powder dry to some degree, or you want to maybe keep in mind that this election is going to be meaningful not just because of the policy out there, but also because we're going to run straight into year ahead positioning, and we often then have this combination of factors: year end momentum into year end, and then year ahead positioning, and the election will have an impact possibly on both of those. So you, at this very moment, you probably want to think about what are the opportunities that are not so sensitive to the election outcome. And one of the areas that I find interesting, it goes back to some of the central bank RV, which is, what are the central banks that could become more dovish relative to what's priced here, and where are the ones that are on the other side. And kind of what stands out to me in that regard is we're still pretty modestly priced when it comes to the Bank of England, and whether that's policy rates or whether that's market rates more broadly, they really mirrored the US much more than European rates or maybe global rates more broadly. Plenty of debate. We have a UK budget this week, which I think comes out before we will release this. It has been popular and very, very frustrating for investors to play the more dovish Bank of England route. But I do think that there is room where we're pricing less than 25 basis points a cut for the next couple of meetings. So I think there's clearly a sensitivity to the dovish side and in front end UK rates. Now, on the other side, it's probably Japan still. There are a couple of central banks where I think markets are now pricing a lot of dovishness. So whether that's Canada or New Zealand, so you probably want to keep those in mind. But I think in terms of the risk reward, the most obvious at this point to me is probably the Bank of Japan. We're pricing very little for the December and January meetings still. The exchange rate is very weak. Inflation is surprised to the upside again. We have an election result which suggested a lot of concern about the cost of living. So I think whether it's paying Japanese rates outright, or again that RV between Japanese rates and UK rates, and I think it's cleaner than it was at some point, in part because it didn't work nearly as well to be long Japanese rates against, for example, the US some time ago. So I think that's one theme that I find interesting at this point. A broader theme to me is we have this big soft landing consensus, and to me that does suggest that the tails are somewhat underpriced, and the tail that I'm a bit more focused on right now is the upper tail, if you like, the idea that you can get maybe a hint of reflation, or maybe simply a late cycle acceleration in that very surprisingly robust equity momentum that we've seen. So what we've had was consistently underpricing equity upside. And again, sometimes late in the cycle, you can get this sort of spot out, ball up type dynamics. So again, the election and earnings in the very near term mean you may want to either wait or look at kind of forward starting optionalized exposures to equity upside into the first half of next year. Again, I think at some level both tails are potentially attractive. So if you think markets are on the wrong foot when it comes to recession risk, then there's certainly lots of attractive opportunities at this point. But I would certainly keep that upside tail in mind as well. But the others, as I mentioned, I think we are close to the period of year ahead positioning, and I think that's usually a moment where, depending on the mindset, but there's almost always an interest in finding quote unquote cheap upside exposures, and I think this is a moment where cheap equities will feature in that regard. And I already mentioned European equities, but I do think that's also potentially a moment for EM equities, and that's partly because of the China effect, both directly and indirectly. I mean, directly in the sense that people will pay more attention to potential China upside, but also simply because they've seen very cheap Chinese equities become much less cheap, and they will therefore look at other EM equities with a somewhat similar vantage point. So EM equities, I think, will be interesting for year ahead positioning. And in FX, I think that's actually another episode where the yen could be interesting. I think it's interesting even in the context of the election, because we're rate sensitive, so we're pricing quite a lot of yen vol for the election. The Ministry of Finance is not far from intervening, and it likes to intervene around big risk events in the US. So combination of payrolls and the election, should we see dollar yen go further and closer to 160, I think brings those intervention thresholds closer. The last 2 years, we've done really well being long yen into November. So I think the yen looks attractive in that regard as well. So I would leave it.
And you mentioned the yen. So what's your view on the US dollar more broadly?
So my view is over that kind of horizon that I described, kind of 6-month-ish view is pretty positive, and I see kind of the structural reason ultimately linked to that US outperformance, a close link between the performance of the US equity market, the US dollar, and to some degree the US economic cycle. And I think those all three of those still have some room to run, but we're obviously in the later legs. So you got to be mindful that that's again probably a view over the next 6 months. It is also reinforced in the nearer term by this idea that we are getting economic and policy divergence, and that's going to be obviously affected by the outcome of the US election. And I say this because, again, at this point, markets are somewhat focused on a Trump victory. So being long the dollar at this very moment is certainly not riskless, and the risk reward short term is, I think, modest. So it's more a buy on dips, and you may have to be a little bit patient in case you get a.
So with something like the euro, I mean, do you think we could go back down towards parity, for example?
I think that certainly in the Trump unified government outcome, in a world where, again, we're also seeing policy divergence, and I should have said, I think there is a clear path to a 50 basis point cut by the ECB, and again, by the time this airs, we may be much closer to it, or it may have to wait a little bit longer, because it really only takes one more significant downside surprise in Eurozone inflation to get there. So I do think parity is a distinct possibility. For the time being, I am still bearish euro dollar. But again, I think at this very moment, do you want to put that on into an election where it's not the most stretched currency in an election context? I mentioned relative term dollar yen, dollar mex is another one where you're pricing a really big risk premium for this election, but it's not an obvious risk reward at this point to be short euro dollar at this level.
Okay, great. Well, we've covered a huge amount of ground here, so I really appreciate that. I did want to round off with a few more sort of personal questions. One was, you've been in markets for a long time now, and you've spoken to lots of investors. What's the best investment advice you've ever received from anyone else?
Yeah, so I would highlight maybe two things that are similar in perspective, and they're really about finding your blind spots. So in my experience, and what the number of investors actually over time have fed back to me, what you know is often less important than what you don't know. And a related perspective to that is, it is equally important often to know what everybody else knows. And in the end, this is really a call both for diligence and doing your research, but again, also for humility and being mindful. Overconfidence and has been, I think, much more costly to investors than many other trades. So be mindful of what you don't know and what everybody else knows, just as much as you're trying to form, a central thesis.
Great. And then we have some younger people listening to this podcast as well, many of which will be graduating from university either this year or next year. What advice would you give to younger people as they enter the real world?
So the single best advice I would maybe offer is stick with something and try to get really good at it, and don't sweat too much over what exactly it is or whether it's exactly what you're planning to do for the rest of your life, because expertise, experience, and excellence really are multipliers, and they breed huge dividends over time. So whatever you're doing, give it a really decent shot. Be consistent, which is a skill that is, I think, usually underrated, and you will end up reaping the dividends from that over time.
That's a great piece of advice. Now, I see you're sitting in front of a bunch of books, and I love reading. So what's some book recommendations you'd give?
So there are many, but maybe the one that I would highlight that probably gave me more food for thought than anything else I've read of late is a book called The Longevity Imperative by Andrew Scott, who's a London Business School professor, but also happens to be one of my PhD advisors. But that's not the reason I'm recommending the book. It's really a fascinating read, and the central premise of the book is just to reinforce the point that we're really looking at a longevity revolution. So the life expectancies have consistently risen really globally over 100, 150 years, and there's no end in sight. But what's so remarkable about this book is to drive home what are really major implications for your personal life, for policymakers, but also professionally, because the implications here extend to the somewhat obvious, which are, if people live longer, we have to think about how you structure pension systems, but they're also very much about the health span is changing just as much as lifespan is, and that's very comforting because that maybe offers you an avenue towards addressing some of these pension questions. But it also throws up a really interesting personal question, which is, how am I going to structure my life if I look forward towards working perhaps into my 70s and maybe 80s. So a huge amount of food for thought in that book. I think it is one of the mega trends. I know you have a lot of interest in AI, and I very much share that. But I think longevity rivals AI in its potential significance, and I think this book therefore is really important. It's been hugely impactful for me, again, personally, from a health perspective, but even thinking about future career paths. So I really couldn't recommend it anymore.
That's fantastic. Now, final question was, what's the best way for people to follow you and your work?
So at the moment, it's probably LinkedIn. So I'm working on a few things, but I try and share and be available on LinkedIn. Been a little quiet, so I'm planning to be a little more visible, but we'll certainly encourage people to share ideas and thoughts, and I'm always interested in a good discussion and conversation.
No, that's fantastic, Ebrahim. So thanks again for such an enlightening conversation, and good luck with all your various endeavors that you're engaged in.
Really enjoyed it. Thanks again for having me.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.